Imagine this. You wake up on a random, grab your phone, and see a notification. $500 just hit the account. No shift was worked. No DoorDash runs. No side hustle at all. That $500 covers a car payment, pays for groceries, a utility bill, or helps build an emergency fund.
For most beginners, this sounds like something only rich or finance people can do. But this is the kind of passive income anyone can build with dividend investing, starting from small amounts and growing over time. In this video, a beginner-friendly breakdown will show exactly how much needs to be invested to make $500 a month in dividends, using 3 clear paths: the conservative route, the income seeker, and the accelerator. So anyone just starting out can see what's realistic for them. Most people think millions of dollars are required to ever live off investments. They picture Wall Street, not regular people with normal jobs. But what if the goal isn't retire rich? What if the first milestone is simply an extra $6,000 a year? $6,000 a year is $500 every single month. That's an emergency buffer getting topped up automatically. That's holidays and birthdays paid for. That's less stress every time a bill shows up. And along the way, the common trap that ruins most beginners in dividend investing will be exposed, so that wealth can be built instead of destroyed. First, the math needs to be simple.
To get $500 a month, the portfolio must produce $6,000 a year in profit. The price you pay to get that $6,000 depends on one key number: the dividend yield. The price you pay to get that $6,000 depends on one key number: the dividend yield. Dividend yield is just annual dividend per share divided by share price. If a stock is $100 and pays $3 a year in dividends, that's a 3% yield. If a fund is $20 and pays $1 a year, that's a 5% yield. Sounds simple, but this is where most beginners sabotage themselves. They open a brokerage app, sort by highest yield, and see a stock paying 12%. The thought shows up: perfect. Only $50,000 is needed to hit $500 a month. Stop there. If a company is paying 12% cash just to hold its stock, there is almost always a problem. The stock price might be crashing. The business might be drowning in debt. Future earnings might be collapsing. Sometimes the dividend is high, not because the company is generous, but because investors don't believe that dividend will survive.
A common story: a company showing a 15% yield because its stock price fell hard. Income chasers pile in for easy money. Months later, the company cuts the dividend in half and the stock drops even further. The result? A much smaller dividend and a much smaller account balance. Chasing the highest yield is one of the fastest ways to turn $50,000 into almost nothing. So instead of playing dividend roulette, 3 structured paths to that $500 monthly dividend paycheck will be laid out, each one designed for a different risk level and personality. Before those paths, a quick note for anyone who wants simple, no-jargon explanations on building wealth, paying off debt, and investing for beginners. Consider subscribing. Here, the focus is on high-quality dividend aristocrats and broad markets. Dividend aristocrats are companies that have not only paid dividends for years, but have increased those dividends for decades consecutively in a row. Think of household names like Coca-Cola, Johnson & Johnson, or Procter & Gamble, plus broad index ETFs that own hundreds of companies at once. Typical yield range here, around 2.5% to 3.5%. Let's use 3% as a simple middle ground. These companies are boring, they are slow, and that is the point. What many beginners miss is that these dividends often grow every year. A 3% yield that grows 5 to 8% per year can quietly turn into 4%, then 5%, then 6% on the original cost over a long period. For example, Coca-Cola has paid dividends for more than a century and raised them for decades consecutively. And Johnson & Johnson has increased its dividend for around 60 years in a row.
These aren't meme stocks. They are slow, steady, wealth-building machines. Now, what is the price tag for this safety? To get $500 a month, $6,000 a year, at a 3% yield, about $200,000 needs to be invested.
6,000 divided by 3% equals $200,000. That number can feel like a mountain if the current starting point is close to zero. But remember what this path is designed for. A portfolio that can last for decades, often through multiple recessions, while continuing to pay and grow those dividends. It's a long-term build wealth safely route. For someone investing consistently over 10 to 20 years through retirement accounts and regular deposits, that $200,000 becomes a realistic target, not something that needs to appear overnight. Still, not everyone wants to wait that long or can realistically reach that number quickly. So, Path 2 cuts that requirement merely in half. Path number 2, the income seeker. This is where a lot of the financial independence community operates. Instead of only holding conservative dividend stocks and broad ETFs, this path starts mixing in higher yield assets like REITs and covered call ETFs. REITs, or real estate investment trusts, are where you own income-producing properties, apartments, office buildings, storage units, data centers, shopping centers. By law, they must distribute most of their taxable income back to shareholders as dividends, which is why their yields are often higher than average stocks. Covered call ETFs use option strategies to generate extra income from the stocks they already hold. In simple terms, they trade some potential upside for more consistent cash flow today. In this income seeker lane, typical yields might be around 5 to 6%. Let's run the numbers. At a 5% yield, a $6,000 per year goal requires about $120,000 invested. At a 6% yield, that drops to around $100,000. So on this path, the price tag for a $500 monthly dividend paycheck is roughly $100,000 to $120,000 invested. Compared to $200,000, that suddenly looks more achievable. The capital requirement is almost cut in half simply by changing the mix of investments. But that discount comes with a trade-off: more volatility and more risk. Real estate can be very sensitive to interest rates. REIT prices can drop when borrowing costs rise or occupancy falls. And covered call funds can lag when the market shoots up because some upside has been sold away for income.
During big market corrections, these assets can fall harder on paper and occasionally cut their dividends. So this path is best suited for someone who wants higher income now, is comfortable with more ups and downs in account value, and will not panic sell the moment a chart turns red. Before moving to Path 3, a quick engagement pause. If this breakdown is helpful so far, dropping a like or a comment helps signal that more dividend investing content like this should be created. Path number 3, the accelerator. This path is built for someone who wants cash flow as soon as possible and is willing to actively monitor their portfolio. Here, the mix may include business development companies, certain energy and pipeline stocks, and other higher-yield income plays.
Big development companies lend money to small and mid-sized businesses at high interest rates, and similar to REITs, must distribute most of their profits as dividends. Many energy and pipeline companies also pay substantial dividends due to their business structures and cash flows. In this space, yields of 8 to 9% are not unusual. Sometimes even higher numbers appear. But as always, higher yield usually means higher risk. Using that 8 to 9% range, at an 8% yield, roughly $75,000 is needed to get $6,000 a year. At a 9% yield, that number falls to about $67,000. So, on paper, the $500 monthly dividend goal can be hit with somewhere between $67,000 and $75,000 invested. That sounds incredibly attractive. Less capital, more income, faster progress. So, why doesn't everyone do this? Because this is also the lane where things can break the fastest.
In recessions or severe downturns, these are often the dividends that get cut first. Businesses default on loans, energy prices crash, profits fall, and those 9% yields can drop to 0% overnight while the stock price also drops. This accelerator approach is like driving a race car. It can get to the destination much faster, but it requires more attention, more skill, and a higher tolerance for bumps and crashes along the way.
It can be powerful when used carefully. It can be disastrous if used blindly. Before moving money into any of these paths, one more silent factor needs attention: taxes. Unless dividends are being earned inside at a tax-advantaged account like a Roth IRA, the government will want a piece of that income. If the tax bracket is around 20%, a $500 gross dividend payment becomes roughly $400 after tax. So, if the real goal is to actually spend $500 a month from dividends on groceries, bills, or fun, that pre-tax income target needs to be higher, closer to $650 a month. That means instead of $6,000 a year, the real goal might be closer to around $8,000 a year in dividends, depending on the exact tax rate. That adjustment increases the amount needed on each path. The conservative route might need closer to $260,000 at 3%, while the income seeker might need around $130,000 to $160,000 at 5 to 6%. The accelerator might need roughly $90,000 to $180,000 at 8 to 9%. This is why pairing dividend investing with smart use of tax-advantaged accounts is such a powerful wealth-building strategy.
Now, all of these numbers, 75,000, 100,000, 200,000 plus, can feel overwhelming. Here's the part most people underestimate. None of that has to be in place today. Dividend investing is a snowball. On day one, the portfolio might only pay $5 in dividends. It feels useless. It feels like nothing is happening. But that $5 gets reinvested. It buys a few more fractions of shares. Next time, the dividend might be $5.10, then $5.50, then $6. At the same time, new money is being added each month: $50, $200, $500, whatever the budget allows, over 5, 10, or 15 years. That combination of contributions plus reinvested dividends creates a compounding effect that is almost invisible in the beginning and incredibly powerful later on. The real goal isn't to magically jump to $500 a month in dividends tomorrow. The real goal is to start the snowball today, so that in 10 years, the avalanche is unstoppable. And to make that snowball move efficiently, one more question must be answered. What is the lowest monthly amount that needs to be invested to realistically hit these kinds of income goals?